Today we're going to talk about why the lowest interest rate is not always the best loan for you. We're going to talk about some of the other factors that you really should take into consideration as you are evaluating the home loan products that are made available to you. My name is Sharon McLennan. I'm a real estate broker with over 25 years experience and a licensed CPA. And today I want to talk to you about some of the other things that you should focus on as you're going through your home financing journey. So without further ado, let's dive on in. A lot of home buyers get locked into one or two factors that they take into consideration as they're looking to evaluate the loan products that are being presented to them. The two most popular ones, the two biggest mistakes that I see buyers making when they're looking at loans is focusing in on only two factors. They focus in on the interest rate and the monthly payment. And while those things are absolutely very important, it's critical to understand that there are other factors that make up your loan, and you want to make sure that you spend some time evaluating those factors to come up with the best combination of features in a loan that make it work best for you. So make sure that you're taking the time to understand the full picture and all the things that contribute to the final loan product that you are going to be signing up for or that you're going to be taking advantage of before making the decision, and not just relying on, hey, what's the rate and what's my monthly payment going to be? So what makes up your total loan cost? Of course, the interest rate is a factor. That's the annual cost of borrowing. And as I mentioned before, that is absolutely important to take into consideration. But there are also some loan fees, costs that you pay upfront, typically origination, underwriting, as well as some closing costs that you incur as a part of that loan application and being able to take advantage of that loan process that a lot of times many home buyers just really don't focus on and end up either being surprised or making decisions that just don't really put them in the best possible place relative to the suite of options that were available. Another factor to take into consideration is mortgage insurance, be it PMI, private mortgage insurance, or MIP. This is a requirement, and typically this is present when you borrow more than 80% of the value of the home. So you are taking, you're not putting down a 20% down payment. Typically that triggers some type of mortgage insurance, and the mortgage insurance has a premium that is built into your payment. So every month as you pay your principal, interest, taxes, and home insurance, if it's escrowed, there's also a mortgage insurance component that is added to that payment. And that goes in many cases for the duration of the loan. And you want to make sure that you understand whether or not the product, the loan that is being offered to you, does it have a mortgage insurance component? And if so, approximately what does that monthly premium look like? You also want to take into consideration the loan structure. Is it going to be a fixed versus adjustable rate? If it's adjustable, what are the terms of the adjustment? Will it adjust every 3 years? Does it adjust every 5 years? What are the terms of the adjustable rate? Because differences in those type of terms will translate to differences in rate and can translate into differences in upfront costs that are required for you to be able to get the mortgage. And then last but not least is flexibility. Some mortgage products come with the understanding or the encouragement that you may want to refinance the property, the project. You may want to refinance the loan over the course of the next few years. So does your loan have a prepayment penalty in there? In other words, is there a period of time that if you refinance or pay off that loan during that time frame, it'll trigger some type of penalty for you? Or is it one that will allow you to refinance almost immediately, the need to do a new appraisal, or without having to incur additional closing costs? All of these are terms that are available in some loans and can be negotiated in others, But if you're not asking those questions, it's highly unlikely that you are going to get the most favorable terms if you're not keeping an eye on these things to come up with what is the best packaging, what is the best set of circumstances that would work for you given the loan that you are looking to secure. Now, one of the things that buyers often overlook is that there is a rate fee trade-off. While we're focused a lot of the times on getting the best rate, typically what that translates into is a lower rate equals a higher upfront cost. So many times the way that you get the best possible rate is that you do what is called buying down the rate. You buy down the rate, meaning you pay extra on the front of the loan to be able to get a lower rate as for the remainder of the life of the loan, so that when you pay, your payments end up being lower. Now, one of the things to keep in mind is that a rate buy down is not necessarily a bad thing, but you have to look at it in the context of, does this make sense for me financially? For a rate buy down to make sense, you have to make sure that you are going to be in that loan. You're going to still be paying that loan for a certain portion of time to offset the costs that you incurred to be able to buy that rate down, to get that lower rate. So what do I mean by that? And I know it's a little bit confusing because now we're talking about math and we're talking about doing calculations. What you've paid to reduce the rate is recouped in this monthly savings every month from paying the mortgage. That point, that's called the break-even point. And so when you get to, you have to make sure that when you're making the decision to buy down the rate, you are going to be in the property. You're going to have that loan long enough that your savings at least matches, preferably should be, your savings should be more than what it costs you to get that rate reduction, right? So let's look at what the break-even point is and how we actually calculate that. So the break-even point, say for example, it's going to cost you $5,000 to be able to buy down the rate. And as a result of this lower rate, you are going to save $75 a month over the life of your mortgage. $75 a month, it's going to take you 67 months, which is 67 times 75, to actually come up with, to have saved the $5,000 that you paid up front to be able to get that lower rate. So the question is, do you plan to be in the house at least 67 months? Are you planning to keep that loan for 67 months? Because if you aren't, then you paid more on the front and you didn't get a chance to recoup those savings. So say you know that you're going to be moving, or you're going to be refinancing, or you plan to refinance in the next 3 years, which is 36 months. It doesn't make sense for you to pay $5,000 to buy down the rate, because over the 36 months, you are not going to save with $75 a month. You're not going to save enough to offset the $5,000 that you paid. So super important to make sure that you're clear and that you're doing the calculation. Buying down the rate is not necessarily a bad thing. It just is something that should be taken into consideration in light of all the plans that you have. Now, it may be that you say, hey, I don't have any plans. I plan to be here indefinitely. It probably be 7 to 10 years. Then okay, buying down the rate makes perfect sense. But if you are in a situation where you're expecting to be, say, finished an educational program and you're going to move to another part of the country, or you think your job is such that you get stationed in different parts of the world and you don't know how long you're going to be here, and you don't want to keep property here if you're not going to be living here, then maybe buying down the rate might not be your best alternative. Again, the idea is to make decisions with knowledge and make the best decision for you, because at the end of the day, just looking at the number, it sounds great, but in the long run, we don't want to pay $5,000 to save $3,000 over the course of a few years, because then you're $2,000 short of actually that being a good decision for you. So I hope that makes sense. I know it's a lot of math, and sometimes when we get arithmetic and calculations involved, it gets to be a little iffy, but I'm always available to look at your personal situation to see what your break-even point is and when you would arrive at that. So if you need any guidance as it relates to that calculation, please feel free to reach out to me. I'm happy to help in that way. All right, so let's move on. So we talked about it earlier. Another factor to take into consideration is the flexibility of the loan. Is this a loan that you're getting that will allow you to refinance or to pay off the loan without a prepayment penalty? This is something that you want to find out about. Is there a prepayment penalty on the loan? Is this a loan where it will allow you potentially to refinance and not have to pay for an appraisal or do another appraisal? There are a bunch of factors that can play into how flexible your loan is, and those are questions that you should ask. None of these are going to be the final determinant as to whether you're going to do it or not. But again, it's good to know, so as you're looking at your array of options, looking at your choices, you know exactly what helps and what hurts so that you can make the optimal decision. Again, the goal is optimal decision making, using the information that's available, taking into consideration all of the factors that will impact your financial outcome, and using all of that to come up with an informed decision. So a big part of your decision making is going to be trying to figure out how best to balance the difference between the monthly payment and the total cost of getting the loan. A lot of times we overlook what the total costs are going to be, and if you're paying more to get for a loan up front, then that needs to be taken into consideration rather than just focusing on the monthly payment. If you're able to pay less on the front end, that helps you to preserve your cash. If something comes up that is a repair or an issue outside of the ownership of your home, something that you need to put some money towards, then the more cash reserves that you have, obviously the easier that is for you to meet that obligation. Also keep in mind that the less you pay on the front end, the less you have to come out of pocket. Those funds are available in the future to help address any types of unexpected expenses, any type of financial risk. So don't forget to focus on what the overall total cost will be. So comparing upfront costs when you're evaluating a loan, you're looking at two different loan products. Look at the payment for sure, because that's something that's important and that you're going to have to pay every month. But also ask, by the way, can you give me an assessment or an estimate of what the total cost on the front end is going to be, and factor that into the consideration as well. Having money to be able to take care of life's emergency on the front end will definitely help to reduce some of the stresses that come from home ownership, because a lot of times folks neglect to take that into consideration and they end up being cash strapped. And so when things that are a normal part of life start coming up, they find themselves pressured because they don't have the cash available to meet those types of events or those types of emergencies. So keep that in mind. We're not looking to deplete all of your cash reserves on the front end to get into the house to maybe save a $50 or $75 a month. Do the analysis to see how much of a cushion would you have if you went with the slightly higher payment, if you didn't decide to buy down the rate, and compare that to the amount of flexibility that you would have by having these cash reserves in your bank account and available to meet any of life's demands or any pressing concerns. So the takeaway on this should be that the right loan depends on your situation, right? There's no right or wrong loan. A lower payment might be the best thing for you given your situation, but it may not if it drains all of your cash reserves on the front end. So the right loan is going to depend on your situation. Look at your time horizon. How long are you going to be in the property? If you buy down the rate, are you going to have enough time to be able to recoup those costs and have that be real tangible savings for you over the time that you have the loan. Look at your cash reserves. Is paying down the rate going to significantly deplete the resources that you have and leave you cash strapped, which again is a problem, because what we're shooting for is not just home ownership, we're shooting for sustainable home ownership. So that's the ability to pay your mortgage as well as your other bills and not get stuck in as if something unexpected comes up. Also, you want to take into consideration your job stability as it relates to keeping the house, staying in one location. So the geography of your job is going to be important. But also, if you're in an industry that's going through significant turmoil, or you're in an industry or with a company that is downsizing or on the cusp of downsizing, if you're even aware of that, you want to take that into consideration again, because at the end of the day, you don't want to be in a place where you have a mortgage and you have no income to be able to meet that payment. And then, of course, your future plans, what you're looking to do long term. Is this going to be a property that you're going to buy to hold on to if your needs change? You'll upsize or downsize, but you plan to keep the property as a rental property and keep that same mortgage. Then, depending on your anticipated timeline, this might be the best option for you. It might be to buy down that loan and get a lower rate. So all of that factors into the decision-making process and what you should be looking at as you try to decide which loan product you're going to select. So the right questions to ask are, instead of saying, what's the lowest rate you can give me, is what loan products are available, and making sure that you get all of the details, what the upfront costs are going to be, what the restrictions are in terms of prepayment penalties, flexibilities, what am I paying upfront, what's the monthly payment. Get all of the information that you can, any requirements, any restrictions that are a part of the loan. Ask for those to be disclosed to you, and then with all of that information, you can make the best possible decision for you as it relates to which loan product is going to best serve you and meet your needs. In closing, the best loan isn't always the lowest rate. Important to remember that. It's the one that fits your life. Again, we went through a bunch of different options and we talked about some different calculations. If you need any help going through what your loan options are, feel free to reach out to me. The best way to contact me is through my website, simplyaskSharon.com. There's a link on the site to book a call with me. We can do a consultation. There's absolutely no charge for it, so that we can walk through what your break-even points are and make sure that you make the best decision from the options that are available for you. I hope you found this video helpful. I thank you for your attention and look forward to seeing you next time.